And the first one of these is fund setup and administration issues. If the panelists would like to make their way to the stage, I will announce them as they come up. Moderating this panel, we have Ray Harstick, who is CEO and founder of Relevant Equity Systems. And the panelists are Laurent van der Weyen, CEO of Altadomus, Bruce Hahn, Director of Fund Administration Services at KCS, and Felix Wong, who is CFO at Qing Capital. Ray, over to you.
Thank you, Tim. Good morning. Hi, how's everybody doing? All right, want to wake you up. We are going to try our hardest to have a lively panel for you today. And we're going to start off with some macro issues like domiciling and fund structuring and things like that. And then we're going to work our way down into fundraising, compliance, and some other things like that. So let me introduce our panel. And we have Laurent from Altadomus, Bruce from KCS, and Felix from Qing Capital. Now, Felix is in the middle, and then we have Bruce on the end. Let me ask each one of the gentlemen to introduce themselves, starting with Laurent.
Good morning, everyone. So my name is Laurent van der Weyen. I'm the CEO of Altadomus. So Altadomus was set up 10 years ago. We are an independent specialist provider for fund administration and corporate services for private equity houses and real estate managers. So we are headquartered in Luxembourg, but we have 15 offices worldwide. And we have an office here in Hong Kong, one office in Singapore, and a small office in Beijing as well.
Great. Felix?
Yep. Hi, my name is Felix. I'm coming from Qing Capital. So we're the first clean tech VC fund in China since 2001. Personally, I've managed 4 funds, 5 funds all together, setting up a few funds during financial crisis and right now recently. My office Beijing, Hong Kong, and Shanghai. So thanks to everyone here.
Hi, good morning. Oh, sorry.
No, go right ahead.
Good morning. My name is Bruce Hahn. Thank you for staying. Please go out and tell them to come in. This is really important stuff. I work for KCS. We're up there. It used to stand for KPMG Corporate Services. In 2002, we spun off, still maintaining an excellent relationship with KPMG. And we have KPMG people here, and we're really appreciative of our relationship. We have offices all over Asia. We're opening up another one in Hangzhou tomorrow. We basically do back office and mid-office outsourcing functions for private equity funds, hedge funds, funds of funds, and other financial institutions in the region. And there's one other thing. A new product line that we want to expand on is capital introduction, fundraising, starting out with Korean LPs. Thank you.
Thanks, guys. And just so you know who I am, I'm Ray Harstick. I'm from Relevant, also up on the board. And we are here at the conference with our local partners, ECFO, and they are they're also in the booth. We do software for administrating your private equity funds, and many of our clients are here at the conference. So we've got 4 guys that eat, sleep, and breathe fund administration, and there's a lot to talk about. But let's start with the premise that somebody here is just spinning off from a firm or has just decided that they're going to raise a fund. Where are they going to domicile? And Felix, would you help us?
I think this is easy and also difficult questions. Most of the time, I think we're a China fund, and around this region of Asia, there's a lot of China fund here. Most of the common structure you've seen is Cayman Island partnership, although you will see some other like in Singapore and some others even Hong Kong or maybe US, Delaware, something like that, which is common. I think the one reason is that market practice, and you can find readily available service provider to help you, and the cost is more or less manageable. Yeah.
Excellent. Laurent, would you?
I think it would very much depend on where you want to fundraise and where you want to invest. So we see a multiple type of setup with our clients today. Hong Kong being the center for the management teams, using Cayman structures. We see more and more Singapore being selected as a domicile of choice when it comes to investment in India. Singapore is in the process of signing a double tax treaties with Russia as well. So we believe that we will see more and more funds being set up in Singapore. When it comes to pan-European type of activities, so we see a lot of our Asian clients looking to either use the current platform in Cayman or to set up funds in the China Islands or in Luxembourg. But again, as I said, it very much depends on where you want to invest, what is your investment strategies, where do you want to fundraise, and of course, I mean, the tax element will be a very, very important thing you will look at in order to define what is the best structures for your investors.
So I'm hearing you want to look at the country you're investing in, look at some of the tax treaties, look at the talent base that's available there for administering your funds. Okay. Let's move on to fund structures. And when you're getting off the ground, more often than not, you're going to have a Cayman vehicle. Should you add a local vehicle in the local currency? Felix, do you want to take that one?
That's a tricky question, usually when you set up, like when I help my deal team, how the deal is being structured in doing that, because normally it's a Cayman Island structure, and beyond that, there were different like individual management account, nominal account, or fund of funds, or maybe even feeder fund individual. So that's one layer. So that will be taken care of by our usually tax representative, tax consultant, or maybe lawyer. And then underneath is under investment vehicle. So that's mainly taking about, if my considerations tax is one thing, from flow from down below to up.
So you're going to have a blocker in place.
Yes,
yep.
there will be. This is more or less for dollar fund. And then for, I think, here there's a, you heard about RMB fund?
Yes,
RMB fund structure is very simple because China tax every single layer, even dividends. So in China, usually just a partnership and then portfolio company. On top of tax structure, actually, another time I'll consider another option because most of the time when you come to exit channel, right now, particularly, I think this morning or the panel today afterwards, we were talking about M&A rather than IPO, particularly in China market. So in order in the futures now, if you want to get exit rather than just simply the tax, you have to cater a structure flexible and versatile enough for them to sell. So you're not going to sell the whole fund altogether. It's deal by deal. So when I set up the vehicle structure, I will ask my team, hey, there may be a SPV here, but you may have split SPV underneath in order for the futures that, okay, someone is partially interested in one deal, but not the other deal. So you can just plug it out and sell it. So that's, I think, when I manage the fund, is that how do you foresee the fund life, first of all? It's 10 years. There's a lot of changes.
A long time.
So you want to make sure that you will not be deadlocked in certain. It's actually some life experience in the past. Like you don't have a vehicle, and then like we invest in my former company, a Canadian company. So we directly holding that. So there's no tax. We have to, before we go for IPO, we have to pay tax. But you're not guaranteed that you recover that. So that means at that time we do not need a proper structure. So we end up at the time find a Barbados company to figure that. But that was tough. Yeah.
Laurent, what do you see in terms of fund structures?
Again, very much depends on the investor base and the location for the investment. We see everything from the very, very simple structure, fund going direct, and we see, structure chart that's, A3 type of structure chart with, 50
and when you get
boxes.
to real estate, it's kind of like taking a bowl of pasta and throwing it against the wall, and you've got fund structures everywhere.
And again, it's all about, all together with your tax advisor, you will be assessing the different impact on your investors and your investment, the capital flows, the dividends payment, and so on. What we tend to do is to sit together with the client and the tax advisor, making sure that we do understand the structure properly, so that we can deliver back the right level of service to the client. But as I said, I mean, it's a very, very diverse type of setup that we see. Some will be very, very simple because there's just a couple of investors
if
all located in the same area, investing in one target investment in one country, and then you don't need to set up a very complex structure. Otherwise, your administration fee will go up.
Right.
But to accommodate for some more complex investment structures and more complex investor base, set up. You need to spend a lot of money and time sitting with your tax advisor to come up with the right structures, and then you need to make sure that everyone across the value chain will understand what it means in terms of administration.
Yeah, it seems to be you need to go out, get the best advice you can from your attorneys, from your tax consultants, and come up with the right structure. And it's changing all the time. And what we notice at Relevant is feeders are in play. There are a lot of feeders out there coming into your fund, which might have a parallel vehicle, and then you have your blockers on the other side, and it's a fact of life. And then to make things even more complicated, you've got LPs sitting down saying, hey, I'm going to give you a $50 million commitment if I can have my own managed fund that invests side by side with your funds. And you say, gosh, that $50 million commitment is going to throw off $1 million in management fees.
I think
I guess I'll do it.
This is very true because, like these days, if you want to raise bigger size funds, let's say 800, 1 billion, where are you going for the LPs? Those LPs may be Middle East, sovereignty funds. So 50 million tickets, so they will just their own agenda. That you may need to have side vehicle for them.
Yes.
So that means like our fund, and then we will occasionally set up at their request, and then you have the side pocket, not side pocket, and then a side vehicle parallel.
Right.
So then you will come into a situation after you close the fund, how's the allocations? And then if these are in the same jurisdictions, then you have the same tax regime to take care of. But if it is in, one is Europe, one is Cayman Island, or even somewhere else. So how do you handle all these, take care of these administration work?
One big piece of advice that I've heard is when you have that monster LP coming in and saying, I want to be 25% of your fund size and I want my own vehicle, you need to be very above board with your other LPs and say, listen, we can do much better deals, much bigger deals, we can have more discretion, but you need to be above board with it. You need to set expectations accordingly with your LPs.
If I may add something, so what we have seen in the past few months is the regulatory framework and the substance requirements having some impact on the way you will be structuring your investment. In some countries now, in order to make sure that you will be safe from a tax compliance point of view, I mean, you need to have sufficient substance on the ground. So it might definitely change the way you look at the tax benefits ratio versus the additional compliance burden that you will have to take into consideration when setting up your overall structure. Absolutely,
and we're going to get into compliance. So let's take a step back. We've made our domiciling decision, we've made our fund structuring decisions. Now we need to build a staff. Bruce, tell us where KCS and a team like yours can come in and help us out.
I think the place where we can add value, and GPs or potential GPs should look at, I think, are a few things. Number one, scale, presence, expertise, and price competitiveness. For instance, KCS, we have 13 offices spread out over Asia. Starting tomorrow, we'll have 14 in Hangzhou. All our staff are Big Four trained accountants from either KPMG or the other Big Four accounting firms. Third, we have major presence in all the major markets. In Hong Kong, right down the street, we have 160 staff. In Shanghai, we have 100. In Beijing, we have 50. And another thing is, all we do are our bread and butter businesses, providing services for these types of companies. For instance, we provide corporate secretarial, bookkeeping, payroll accounting. So I think that when you're a GP, you need to look at, again, scale, expertise, price competitiveness, and location in various offices.
Now it sounds like you're painting a pretty nice picture there. Yes. So I could just say, hey, I'm a deal guy, I understand my business, I'm going to start a fund, I've got this reputation and track record. What I don't have is the team. I can turn to somebody like you and say, hey, can you outfit me with a team?
And the answer is, for startup funds or smaller size funds, the answer is yes, we can. We not only provide these types of basic services, we also provide interim services like interim CFO or interim accounting. For instance, if your fund size is small and you have to worry about expenses and costs, then you should definitely come and talk to us or people like us. We could help you with that. Now, the the bigger size funds, and they happen to be our big competitors, they rather do it in-house. That is a fact. But again, for startup funds, smaller size funds, you should definitely think about outsourcing versus doing it.
But the thing that I've been coming to Asia now for 15, 20 years, and in the early days, does anybody remember the H&Q CFO conference that Paul Denning used to run? He would run this conference. It was about 10, 15 years ago, and there would be maybe 50 people in the room. the base of financially astute private equity folks is not, it's growing. Don't get me wrong, it's growing. But finding that finance and accounting talent that understands private equity and partnerships and investing and fund administration can be really hard to find.
That's why, again, I emphasize that you have to look at a firm like us, which we have a long history, we have experienced staff, we have presence in all the various markets, and we've been doing this for decades now.
Now, before we finish this topic, you had some market size information you wanted to share with our group.
I'm sorry, I went through my notes. I actually attended this conference last year, and a major government official from Hong Kong government, who's in charge of finance, he threw out some really interesting numbers. He said, as of last year, the Asian private equity market was about a $411 billion market, which is a 9% increase from the year before. And based on $400 billion capital under management, the 2% private equity management fee yield an annual management fee income of about $8 billion US.
Well, we all know that's only the first 5 years or so.
Of that amount, fund managers would need to allocate about roughly 4% for fund administration and 2% for back office administration. So this is about a $480 million market, roughly, about a $500 million market. And there's been really good trends among Asian private equity. Everyone knows fundraising market this year is bad. Last year was worse, and the year before wasn't so good either. I don't know about next year either. But the trend is that even though Asian GPs, they don't like to outsource, is changing because the private equity investment agreements, they provide for fund administration services to be a direct expense of the PE fund. This is really interesting. And this is separate from the 2% fee, which increases the take-home fees for the GPs. So this is a positive incentive for PE funds to outsource their fund administration needs.
So let's, I'm going to skip that middle topic and we'll come back to it, but let's jump over to fundraising. So we all know the climate has been a little tough for fundraising. What are you guys noticing? Felix, did you raise a fund recently?
Yes, we closed it.
Yes.
Just close it.
I know that, yes. What was that fundraising environment like? Was it as easy as the rest of them, or was it a little tougher than usual?
I'm sure there's a lot of experienced fundraisers rather than because we're not a big fund. But to share the experience, I think I've been working through several GP from from a couple of years ago from right now. Went through the two financial crises, 08, 09, and last 2 years. It was very interesting, but it was painful. It was painful. My former firm was our first-time fund, but we did have a hard capital, brilliant fundraising exercise. I think, but it changed a lot, even though a couple of years. China fund, I think, now is past a decade of fund life industry. You do see more fund and fund that they past the 10 years fund life cycle, maybe now extending the fund life, doing the divestment or maybe liquidations. So personally, I think LPs are more or less know who are the well-played guy. And if you have track records, okay, brilliant, oversubscribed. But if not, bang, right? And then
maybe one bad investment, and
yes,
you're in the punishment area for a little bit.
But lesson learned.
Sooner or later, the track record overwhelms and wins out.
And also, I think LPs are looking some other interest instead of just simply China fund. I do last year, particularly last 9 months, seeing more in Asia, not only China, but also Taiwan, ASEAN fund, and honestly, there's a lot of RMB now going out to outbound investment. A friend's working at sovereignty with $1 billion. They're raising a $1 billion fund. I'm not sure he's here today. In short, is that it's getting tougher, but you can still raise money. But now it's more tied to the number and track records. Fund 1, Fund 2, you can raise. Fund 3, you have to demonstrate. Yeah, so it is much more tougher. But LP are more, personally, I like to build more transparent, interactive relationship with LP, saying, hey, if there is any issue, tell them upfront, calling up. But within my company, I also take care of IR, so I would just call up LP, oh, this is...
I want to come back to that, what you just said about Fund 3, right? For so many years, you've had funds have had a great time raising money, but now I think LPs are saying, listen, I gave you money for Fund 1, gave you money for Fund 2. Now I need to see some distributions come my way if you want that commitment for Fund 3. You need to show me that you have discipline for exiting your deals.
Sure.
And,
sure.
Well, not just investing, building value, but also exiting and capturing that value.
Yeah, true, very true. I think last 10 years since my life started at BCP started in 2002. At that time, people were investing internet, e-commerce is later stage, or semiconductor, Taiwan deals come to China, and then sort of things from hardware to software and e-commerce is now talking about O2O. Market's changing, and at that time, the people switch from different sector. But one thing not really changed is that the GP at that time, 5 or 6 years, tend to just focus on investment. Not yet thinking about, from my perspective, the fund management's point of view. How do you perceive the LP expecting the distributions? Deal guys said that this is a great deal, 10x, 5x, 100x, but never think about when I ask them, hey, when do you expect the exit? Right? This is a tough questions. And they say, hey, we need to deliver cash, rather than because the LP, if they do not have cash, you have a great job, but 10 years later, talk to me. But our job is making money and also raising money so that we can let the GP sustain. So this is a continuous exercise. Deal teams tend to be very passionate about this is a great deal, wait for half an hour. But I say, well, if you can cash out right now, do another deal. We are professional. We try to make each deal is mechanical. That's at least my point. You can have your own investor. You like this company, okay, that's your point. But we are managing people's money. We have to return the money. If you can do that, deliver, you can raise the next fund.
Yeah. Laurent, I know you guys come in after the fund is raised, but do you ever get involved in answering some of the fund due diligence questionnaires and other things like that that are floating around out there?
Yeah, as you say, I mean, we do tend to act after the fund has been raised.
Yeah.
But maybe to echo some of Felix's comments, so I think that it's very diverse. I mean, some of our clients have had a very diverse fortune in fundraising. Ask KKR or Ardian if they have had any problem fundraising, and I think they will look at you and with a little smile on their face. But it's all about, especially in Europe as well. I mean, it's all about, track record, the brand that you have, yes. How capable are you by, exiting and returning some cash back to your investors and good returns. As far as, the help that we can provide in terms of, assisting the clients, it's, looking at the, what we will be putting in place in order to accommodate for all the needs in respect of administrating the register, making sure that the tax structure has been understood, making sure that there will not be any bad surprise in the life cycle of the fund in terms of dividend payment,
tax liability,
and so on and so forth. So yes, I mean we tend to demonstrate that from a tax regulatory compliance point of view, we will make sure that there's nothing that comes up at the later stage that will be considered as a bad surprise for investors.
What Relevant is seeing in our global client base is that fund waterfalls and fund terms are all over the map. They are absolutely all over the map. The days of 2 and 20, if you are a marquee fund, if you've got that long track record, you can show you can get in, invest, get out, you're gonna get your 2 and 20, maybe a little bit better. But we, in that next tier down, we've seen folks with a 17.5% carry, but if their IRR on the capital account floats above X%, then they get their 20% carry. We've seen if they get a multiple of their contributions coming back, like 2.5%, then they can get their 20% carry. We've seen, the deal-by-deal waterfalls, we're seeing them go away. It seems to be back to you have to return my commitment plus interest on the capital calls, then you get a GP catch-up, then we split everything 80-20 or whatever that split is. And we're seeing an awful lot of the takedown waterfall where you have to return contributions to date with interest. So in other words, instead of returning the whole commitment, whatever money's on the table comes off with interest, and then you get your catch-up and then you have your carry. But we're seeing an amazing number of share classes where managers are saying, LPs, pick your own carry. If you want a 2 and 20, great. If you want to waive the management fee until year 5 when the fund is profitable, we'll do a catch-up on that, but we want more than a 20% carry. We've got other folks that are offering opt-outs. And when you're modeling funds, you have to think about these terms every time you do it. Now, when that monster LP comes along and says, I'm going to give you the $50 million commitment that's going to throw off $1 million a year, there's the promise makers that are raising the money that are going to say, we're going to do it. And then there's the promise keepers, the finance team, that have to honor that promise. And they have to come up with that special vehicle just for that managed account. And they have to come up with all of the administrative work to support it. And they've got to weave it into the investments in a proper way. What I'm getting at is the waterfalls can be all messed up. And it used to be if you had share classes, just put everybody with their own set of terms in their own share class. When you have an exit, you can apportion between the share classes and then divvy things up between the members of the share class. Now, when you mix in opt-outs, managed accounts, you may not know who's in a deal or not by the end of that investment. And so waterfalls are going from what used to be a top-down or an apportionment type waterfall to personal waterfalls, where each LP is going to get his fair share on every exit. And because that means with all these changing conditions, that LPs, some LPs that may be paying a discounted management fee or discounted carry, they're going to be catching up in their waterfall a lot sooner than the other guys. I don't want to go crazy on that. All right, so fundraising is tough. We've noted that Bruce has got a new fundraising arm too. We've been asked by the conference director to, they kind of set us up here. And they said, well, we have a fund administrator and we have a systems provider. Why would you go in-house as opposed to outsourced? And Laurent and I could probably present our cases very well, and I think we will. But let's flip the conversation over to Felix for a moment. And Felix, you had to make this decision.
Yes.
Not once, but probably a couple times at different firms. In your mind, what are some of the broad-based differences? We're doing it yourself versus outsourcing.
Well, to be honest with you, since 2006, I've been looking for a fund administrator and someone who can support our services in other funds. Eventually, I did not pick up anyone. I think practically, I'm not talking about Asian fund, which is usually the big boys. Those are, they all have compliance issues. They all need to have that, but not talking about, I'm talking about more the market trend in China that most of fund size will be 200 to 500 million fund. Of course, you can see in bigger fund, billion fund, but even beyond 2 billion fund.
2 to 500 million US?
US dollar fund. Don't talk, well, China is another types of, maybe a small market to talk right now, but talk about mainstream fund is about 500, let's say 500 million. One LP asked me to have, my last fund closing, to have fund administrator. As Bruce said, you have 2% management fee and then 4% or whatever, or maybe you are side pocket deal, whatever, 1%, 2%. it added up a burden of financial cost of the, as a CFO, I have to manage expectation about that. And this is one thing. Second, 5 or 6 years ago when I was looking for the service provider, the pricing schedule or pricing is not flexible enough, still following like that traditional asset base, like 0.5, 1 basis point.
You have more of an ability to pay, so
yes,
they're going to ask
yes.
you to pay more.
You invest more, and then the AUM bigger, you have pay more. But the things you are not necessarily making profit, and our business linking to the incentive, but you have a heavy overhead. So that has to, don't talk about where